And with that being said, I'm going to let Marty and Ryan continue on with the next segment, the U.S. markets and the economy.
Perfect, thanks. So we'll use this slide. This is a slide from Fidelity, and what their economists did, they put together a number of leading indicators. So whether it's wages, unemployment, manufacturing data, could be bond yields, put all these factors together to try to predict a forecast of GDP growth going forward. As you can see, with these numbers, they've predicted 45% chance of an acceleration. So that's anywhere from 2.5 to over 4.5% GDP growth. We saw 2014, we had 2.4% growth. So that would show a uptick in GDP from what we saw last year. They have right there is status quo about 22%. That would be from 1.5 to 2.5%, and odds of a slowdown at 33%. Being a forecast, being an economic forecast, there's no crystal ball of what's going to happen. But using this and using some other data that we've put together, we're certainly optimistic that there's still room to grow in the U.S. economy. So this gets into consumer debt and how much it's declined since the peak in 2007. As you can see, as a percentage of disposable personal income, debt payments made up about just over 13% back in 2007. If you go to today, we're at about a 35-year low of just under 10%. And what does that mean? Consumers are in better shape. They have, they've cleaned up their balance sheets. They have more discretional income to spend on goods. And if you look at what makes up GDP, consumption is almost 70%. So being in a better shape, that's certainly going to help drive the economy forward. Getting into the federal government. So consumers are getting better. The federal government, as you can see, the past 5 years have been lowering their federal budget deficit. Right now we're at about 2.5%. Back just 4 or 5 years ago, we were up closer to 10%. So not only are consumers getting better, the federal government is getting better. They forecast it to be a little bit lower going forward, with it plateauing around 2% in about 10 years. With any forecast, it has a lot of room to change. There's definitely things on the horizon that we need to look out for from a spending and income perspective with the government. But as long as it's a good sign to see them getting the balance sheet in better shape. And 2014, we certainly didn't see some of the political confusion that we've seen in years past. So that was a good sign. And then getting to corporate strength and where the balance sheets are. On average, for the last 20 years, we've seen a debt-to-equity ratio of 162%. Right now, in the fourth quarter of 2014, we saw it at 100%, meaning their debt-to-equity was about a 1-to-1 basis compared to an average of about 1.6 to 1. And what does that mean going forward, and what's the horizon going to bring us? We've seen corporations hoard cash, limit spending in years past. They weren't really sure what to expect with the economy. Now that we've gotten, they've have all this cash, the balance sheets are in check, we may see an uptick in spending, as well as now that higher interest rates are on the potential horizon within, a year and a half, they may try to spend even more and use more capital expenditures to borrow money while it's as cheap as it is before it goes back up. Bring it to the right side. Yeah, perfect. All right, and this goes back, so this chart goes back about 50 years and shows what the GDP growth has been. This gets into the new normal. I'm sure everyone's heard of the new normal, a pretty slow but steady 2% GDP growth in the US economy. In years past, going back, like I said, the 50 years, you've seen, whenever we've been in a recessionary period, we've seen pretty strong uptick in GDP growth quickly following that. The last 5 years, we've really seen about an average expansion of 2.3%. And, what does that all mean right now and going forward? There's been a lot of headwinds in the U.S. economy that Marty will get into a little bit further. But right now, because growth has been so tepid, some of those economic factors are getting stronger, and so there may be even potential for that to grow more than the 2.5% that we've seen and the 2.4% we saw last year.
So as Ryan and Steve were talking about, when we're making decisions on the portfolios, we're looking at a lot of economic data, a lot of economic indicators to give us an idea of what the fundamental economy and what corporations are seeing in their businesses. So when you look at this, these are 4 graphs that I'll explain. If you look at the first, the one on the left-hand side, light vehicle sales. So this is your pickup trucks, your vans that a lot of small businesses use in their business. You can see there's a real drop-off in 08, 09. And then just now, last year, we're above the average amount. So this indicates that for at least 4 or 5 years, the demand had dropped dramatically. And now, as you start to have businesses invest in their capital, invest in their vehicles, you're going to start to see that line potentially go up higher. And so this indicates that really we're just at average, and that to make up for that lost demand over the last 3 or 4 years, we could see more demand in that space. On manufacturing and trade inventories on the far right-hand side, you notice a decline in that line. And basically what that's saying is, since the late 90s, businesses have become much more efficient in the use of inventory. So they're not hoarding a lot of goods and services. They become much more real-time when they're needing goods or services for their manufacturing. And what that would indicate that, even if we were to come to a situation where there is a bit of a slowdown, we don't have a lot of inventories to go through. So really that they have to keep requesting more inventories in order to fund their manufacturing. And that's a good sign. If you look at the bottom left-hand side, housing, last year was a little bit of a pullback from what we saw in 2013. But with interest rates as low as they are, you can see that demand has dropped off substantially from what the average is. So that although in 06, 07 we had a real peak, we had that such sharp decline that at some point you revert back to the average. So with interest rates being as low as they are, there's a good chance that you may see that happen in that industry. On the bottom right-hand corner, real capital goods. This is, in this situation, what's called non-defense capital goods, and excluding aircraft. So really what companies are going out there and investing their capital for equipment, for computers, anything they need for the business. And you can see, again, a real decline that happened in 08, 09, and then just started to go back above that line. And as Ryan mentioned, when you've got so much cash in the balance sheet for corporations, they have the ability to really invest in their business. And when you talk about the new normal, there's a lack of confidence in both consumers and businesses in the economy. And that's really been reflected in part in the market too. So we're certainly not at any point of feeling euphoria, whether you be an investor or whether you be a business owner, but there is a little bit more feeling of confidence in the economy, and that will translate into businesses spending more money. One area that really drives growth in the economy is the ability for banks to be able to lend. And you can see the orange line is real estate loans, so residential loans, and it can be commercial real estate. And then the green line is commercial loans, so banks lending to businesses. And both saw a real decline in 08 to 2011. You see this is year-over-year growth, so if it's above that line, you're actually seeing growth from what it was the previous year. So you can see that residential loans, although they dropped more dramatically in the last several years, there's actually been growth in that area. But you can see in the commercial space, you're just starting to see that right now. You just start to see growth in that space because up to that point, they've actually been declining the amount of loans that banks were lending. So as banks are more inclined to lend to individuals to buy homes, as they're more inclined to lend to businesses to build their business, that is going to flow through the economy and really be an accelerator to the economy. With that said, the upside of this is banks have not really loosened their credit requirements. So in this case, the FICO score, this is for individuals to be able to take loans out for their homes, the residential side. You can see that over, since 2000, the requirements from a FICO score perspective have increased dramatically. And the upside of that is we're less likely to be in a situation where people are taking out loans that they're not able to pay back. And that is a good thing. You want them to be able to get that loan. You want people to be able to buy the house and finance it. And same thing with businesses. But you want it to be done in a very reasonable fashion from a good business sense perspective. Okay, so a lot going on in this chart, but I'll explain. So basically what we have here is the gray line is unemployment. And what you can see, I'll just give you this red mouse over there. What you can see is a lot of up and down, but since 2009, unemployment has continued to drop. So dropping 10% down to 5.8%, which is below that gray dotted line is the historical average, the 50-year historical average. So we're below that amount. So we're seeing improvements in the labor markets, and certainly 2014 was really a strong year in regards to the labor markets. But one of the things that is starting to improve, but is still below average, is wage growth. So that's the orange line. And what you see, the average wage growth is 4.3%. We've been way below that since the 90s. And we've started to see it tick up in the last several years. And certainly it's going to be beneficial if that trend continues. The one thing you have to remember with this, though, is in the 70s and 80s, you had higher wage growth, but you had also much higher inflation, right? So businesses tie wage growth to inflation. So that is definitely in play here, but it's beneficial for us to see wage growth increasing, and more dramatically that happens. You may see some inflationary pressures, but right now, the way the economy exists, that's not really the major concern. It's more a concern of deflation, in particular globally. Okay, so this graph at first view can look confusing, but it sends a strong message as to what we can look at from historical data and imply as far as what we can expect for, at some point, rising rates. So each one of those dots, what it is a period of time where the Federal Reserve raised rates. And what you can see, that orange line says, okay, here are the times where the rates were over 5%, and on the left-hand side, here are the times the rates were below 5%. So right now, we're in that top left-hand quadrant. And what that means is, if the Federal Reserve starts raising rates, looking at historical trends, almost, you can see pretty consistently, all those dots fall in that top left-hand quadrant, which means as rates rise, there's a really good chance that the market will continue to increase, right? That doesn't mean there won't be volatility as the market kind of figures out what's going on. Whereas if we were over 5% in the interest rate that's out there in the markets, there's a much more high likelihood that the market will actually decline. So, certainly there's a lot of concern as investors what will happen when the Fed starts raising rates, just like people are concerned what's going to happen when the Fed starts tapering. Our view is that's a good thing, meaning that the economy is becoming healthy and that we're going to probably see corporate profits increase and growth in the economy. Now, our view may change over time as that rate changes, right? So as the business cycle goes on, if the Fed starts to continue raising rates, at some point, we actually may see the markets decline from that, and it would be a negative. And we're going to be adjusting portfolios when we start to see that happen, but we don't expect that to be the case right now. So, as we're talking here, we're talking about a lot of positive things that we see in the market, because, from that data that we're showing to you, we think there's a lot of reasons to be positive with the market, particularly the U.S. But there are also some headwinds, and we don't want to act like we're not aware of those and considering those as we're managing portfolios. So whether it be concerns over raising rates and the volatility that can exist with that, whether it be concerns over valuations, in particular, let's say the PE ratio, and how that can affect the future of the market to keep going up, that's an issue. Certainly the strong dollar. So what this graph shows is really interesting. How much of the S&P 500, how much of the revenue for 2013 came from overseas? And what you can see is just shy of 50% came from overseas. So what that means is when we have goods and services that are sold overseas and those earnings get reported back to the U.S., it's not going to be converted at the same rate, right? So you're converting sales, but it's going to be at a lower number when it comes to U.S. dollars. So we're seeing that a little bit in corporate earnings now. Now the only question is if you look at other times where there's been a strong U.S. dollar, the U.S. economy has done well, right? So that alone is not a reason that we cannot see continued economic growth and upside of the market, but it is something to be aware of. The other thing to remember on this is just as the revenue could be impacted when those dollars get converted back to U.S. earnings reports, also when companies move money overseas to buy things, now they're buying with a stronger dollar, right? So that labor, those raw materials that we're buying, now we're buying a much stronger dollar. So it's going to help our cost piece of the equation as well. So in anything in economics, there's usually two sides to the equation, and that's what we have going on in the strong dollar. But it is out there, and it's something to be aware of. The other thing that's out there is oil, and what's going to happen with this sharp decline in oil prices. And Ryan will go through and kind of explain our thoughts on it, but it's definitely like anything that we're looking at it, there's going to be pros and cons, and we're going to be evaluating which we think is more dramatic and how it's going to impact the portfolio.